Hi, and welcome to the Adhesion Manager Spotlight for July 25th, 2019. Today in line, we have T2 Asset Management. We have Dan Timitich, who is the Managing Principal and Portfolio Manager, who will be going through some of their models and strategies today. So Dan, please take it away. Thank you very much.
Oh, thanks, Patrick. I really appreciate the opportunity to speak with you and introduce T2 Asset Management to all of your advisors. I really hope that this webinar can be an overview of who we are, what we do, and the models that we have available on your platform. You know, over the last 10 to 20 years, the advisory business has changed a great deal. And with so much information now available to clients, I feel like advisors need to really differentiate themselves, not only from a service perspective, but also from an investment management perspective. You know, in my opinion, the days of the buy and hold investing are over. I think too many people were negatively impacted by that last financial crisis and are looking for alternative investment strategies. And I think those advisors that embrace these strategies can really see a big impact on the growth of their business. You know, for too many years, investors have just been told to kind of hang in there during market corrections and whatever happens, happens. But we all know what happens when the big corrections come. Every advisor, I think, on this call probably has had a client that decided that they couldn't take the pain anymore and just simply sold out at the bottom, and only to miss out on any rebound after that. You know, our investment approach is really designed to deliver active, risk-managed strategies with a focus on downside protection. I believe it's what clients want, and advisors that can embrace those strategies can certainly differentiate themselves. And they could always answer that one very important question that most prospective clients ask, and that's what makes you different. At T2 Asset Management, we've had success with our strategies, and now with our partnership with Adhesion, we can offer our models to your advisors, and looking forward to that relationship with you as well as with all of your advisors. So just jumping into our firm and what we're about, Ken Tomko and I are the founders of the firm. We wanted to create a firm that would offer investors a better process and experience. We built the firm based on the principles of strong diversification, low-cost investing, and the idea that markets are best navigated with the avoidance of large losses. Our firm has long experience and expertise in technical and fundamental analysis, portfolio management, equities, fixed income, and options. And we believe that by combining the flexibility of tactical positioning with strategic thinking, we can better manage the risk associated with each portfolio. Look, we all know that markets are changing all the time, and I think that investment decisions need to be allowed to change with them. Our strategies are designed to quantify that market risk so that we can position the portfolio defensively when the risk is high, and then add some exposure when the risk is low. Our models are designed for investors that are looking for something different and want more out of their investment portfolio. And by combining both technical and fundamental analysis, this will allow us to better control volatility and manage risk more effectively. Here, prior to founding T2 Asset Management with Ken, I've held senior positions at some of the largest firms in the country as a trader, a portfolio manager, and a strategist. I've managed billions of dollars for institutional clients and have seen a lot of things that give me a pretty unique perspective. Ken, he's an experienced market technician and trader. His background is in model building and quantitative investment management. That provides us with a distinctive advantage as we navigate through different market trends and cycles. We're both CFA charter holders, and Ken also holds the CMT designation, which is the Chartered Market Technicians designation. We're members of the CFA Institute as well as the CFA Society of Chicago. So jumping right into this, I think this slide here, I'm sure most of your advisors have seen some version of this over the years, but this is really an important slide. I mean, all of us have lived through challenging economic times. Whether it was the inflationary problems of the 70s, the tech bubble of 2000, or the financial crisis of 08, we were all affected in some way. And yet investors are often told to just hang in there. But for how long? That's always the question. If you're about to retire at 65, can you afford a buy and hold strategy? Are you able to sustain a market correction of 2008? Once again, some investors are, but I think many are not. Our investment approach is to deliver active portfolio management to each and every client. With all the uncertainty in the world today, we always say that the buy and hold strategy has now been replaced with that buy and hope strategy. Here we see what how emotions can affect your clients, right? When markets are moving higher, your clients are so excited and they start thinking to themselves, who needs an advisor? Investing is easy. I know what I'm doing. And then all of a sudden the market starts to roll over. And at first they may think this is temporary. I'll just buy the dip. After all, I'm in it for the long run. And then the panic sets in, right? They start getting really nervous. They finally hit rock bottom and quit. I can't take it anymore. Sell everything. Well, in essence, what they just did was they bought high and they sold low, the exact opposite of what they should be doing. Now, I know every advisor has at some point had to walk their clients off the ledge. Now, imagine what it would be like if you were just using a strategy that would simply make the defensive moves to protect your clients during these huge corrections. That's exactly what our models are designed to do, participate on the upside and protect on the downside. Our goal, in essence, is to provide you with an investment strategy that will allow you to spend more time with your clients, knowing that we will make the necessary defensive moves when needed and move to more opportunistic positioning when the market conditions change. Now, in the most general sense, our strategy are really focused on being fully invested to capture gains during rising markets and reduce risk during these market declines to protect from significant losses. At the center of what we do is manage risk that allows us to preserve those gains and minimize those losses. I'm sure you're all familiar with that Dalbar study that compares the average return investors actually realize versus the S&P and how poorly investors do. Well, by managing risk and allocating the cash during market declines, I think we're making every effort to protect those gains and minimize those losses, which would allow the investors to improve their returns so that the disparity between what they realize and the S&P isn't as bad as it's been. So jumping right into our models here and what we have available on Adhesion's platform, we have 4 models. The tactical equity model is managed by Ken. It's model-based, and it involves the daily monitoring of continuing and newly developing trends. The primary objective here is to deliver a low-cost equity portfolio that relies on technical analysis to capture alpha and manage risk. It falls into the tactical allocation category at Morningstar, and the composite's been around since January 1st, 2016. We use the S&P 500 as the benchmark for this model. I manage the other 3 models, the core equity, flexible growth, and conservative growth model. These models combine strategic, longer-term themes with short-term tactical opportunities. The models are actively managed and aimed at achieving absolute returns with lower volatility over a full market cycle. The Morningstar category for the core equity model is large blend. It's been around since December 31st, 2016, and its benchmark is the S&P 500. The flexible growth model, Morningstar categorizes that as an allocation 70 to 85% equity, and it's been around since December 31st, 2014. The benchmark we use for that is 75% S&P and 25% Barclays Ag. The conservative growth model, Morningstar categorizes it as an allocation 50 to 70% equity, and it's been around since December 31st, 2014 as well. The benchmark for that is 50 S&P and 50% Barclays Ag. Now, our models primarily hold ETFs, but from time to time, we may need to own a mutual fund or two that exhibits some unique characteristics that we simply can't find in the ETF universe. All of our models are based on a rigorous and disciplined process and are oftentimes complementary to other strategies. As a matter of fact, here internally, we've seen advisors use both the tactical equity model along with the core equity model so that they could not only diversify their holdings, but also diversify strategies. It really all depends on what you're trying to accomplish for your clients. Turning to fundamental models, so that would be the core equity, flexible growth, and the conservative growth. The fundamental models at their core, they're designed to keep you invested as long as possible and to take defensive measures when economic conditions deteriorate or when we enter a bear market. They're less sensitive to the day-to-day fluctuations in the market and look for longer-term investment themes. Look, normal markets are going to have their 10 to 15% pullbacks within a bull market. We just don't want to see the huge drawdowns that are typically related to recessions and bear markets. Fundamental analysis, it's much more than just picking stocks and bonds. It requires a thorough understanding of economics, corporate finance, asset valuations, and portfolio construction and management. The vast majority of investment returns, we all know, come from asset allocation. So a deep understanding of these topics will allow for the proper allocation under current conditions and take advantage of various investment opportunities. Look, we understand that market behavior sometimes deviates from fundamentals. That's no secret. So we also have to have the flexibility to make the changes to reflect these short-term variances. We do so by segmenting the model into two separate components, which would give us a more complete picture of the current environment. Let's just jump into how we do that. Here we have two components of the model separated. Looking at this pie chart, the left side is the longer term allocation with core holdings dictated by risk tolerance. As mentioned earlier, we try to stay fully invested here until we see recessionary pressures building or a catalyst appears that could cause a major market collapse. Looking over the next 12 to 18 months, we analyze the macroeconomic environment, the current market cycle, and other fundamental factors like fiscal and monetary policy to get a clear picture of what's happening. This longer term view is going to tend to be cause less turnover and thereby be a bit more tax efficient. On the right side of the chart is the shorter term allocation, where I could draw my institutional experience and allocate to global positions, as well as sectors and other asset classes. This half gives me the flexibility to be opportunistic or defensive, depending on conditions. If things are looking bad, we can increase the cash positions or turn to bonds if valuations are favorable. We can also overweight and underweight stock sectors and market caps. And finally, from time to time, there may be some value in alternative investments that offer some unique benefits to the portfolio. Looking at our tactical models, the tactical model is predicated on market observations and technical analysis. It's designed to stay invested while the markets are rising and remove risk when the trend reverses. Using our proprietary risk model, we score conditions based on daily analysis of major global markets, evaluate technical factors against the macroeconomic environment, identify risks in the market both to the upside and downside. We analyze current market trends, and we adjust the cash levels to reflect the risk or opportunities in the market. The portfolio is generally built with 4 to 7 broad-based market funds that are chosen for their liquidity, low cost, and diversification. If longer-term cash positions are to be held during larger declines, we make every effort to place those dollars into funds in short-term safe income and or cash funds to generate some sort of income. Look, different markets, different exposures, right? By observing market conditions, we can have a better understanding of what's driving market activity. When our technical indicators show potential problems, we'll increase the cash position to capture those gains and reduce risk. And when the trends reverse, cash gets reallocated so investors can capture the upside. In short, the tactical model is basically designed to be in the market when it's going up and out of the market when it's going down. We examine the S&P 500 index across several time frames and apply those readings to our proprietary model. As we see negative trends unfolding, we adjust our tactical outlook and reduce exposure. We do have a fundamental outlook in these models, but we also observe many different data points involving market breadth, volatility measures, sector leadership, and the like. However, these would generally help determine the size of cash positions and would not necessarily be the trigger itself, which is based primarily on prices. Cash levels would generally be somewhere in the neighborhood of 35% during mild tactical declines, but it could rise to 60% or more as long-term issues are detected. So now that you know a little bit about our models, I just want to turn to the commitment we have to the advisors that are using our models. What else can we really help you with? Well, we all know how hard advisors work for their clients, and we want to help them by giving them the necessary information to better communicate with those clients. We're committed to being transparent in our thought process, and we try to communicate our investment ideas on a regular basis. As a boutique money manager, we have the flexibility to work with you in a manner that best fits your needs. If you or your clients want to hear from our portfolio management team, for example, we can do it through a webinar where we can discuss portfolio positioning, performance, attribution, really anything that that pertains to the markets. We're more than happy to accommodate any of you advisors out there that are interested in taking us up on that. We also understand that your success is our success. So if you ever need a portfolio manager to speak in person on a specific topic with your clients or with your office, just feel free to give me a call and or send me an email, and we could get that scheduled for you. I want to thank you all once again for the opportunity to introduce T2 Asset Management. I hope you consider our models next time you're evaluating your portfolio. And as always, if anybody wants more information on our company, our models, our process, or really anything else, feel free to just give me a call or email me directly. My number, I guess, let me flip the slide here. My number and my email are right here. And Patrick, I guess if we do have some extra time here, I'd be more than happy to answer some questions that you guys might have.
Great. Thanks so much, Dan. It was great.
Yeah.
Definitely appreciate that. So, quick question for you. So what role do you see your models really playing within the investor's overall portfolio? Like what role do you guys really want to fill for them?
Yeah, I think so. I guess it's kind of like there's two answers to that. I guess what we consider the fundamental models, I do believe that those should be considered more of a core holding, and the reason for that is that it'll eliminate or remove or reduce the volatility of your overall portfolio. It'll still allow you to capture the gains of the market, but it'll remove the concerns that people have of the market potentially rolling over, knowing that we would be the ones that are already going to be making those changes within the portfolio. The tactical models are more designed for advisors that have already established their own proprietary core holdings and are looking for something that's going to be quicker to react when things go sideways or start to roll over. So when I mentioned earlier that we've seen advisors use both a fundamental core equity model as well as the tactical equity model, it's primarily designed so that they could smooth out returns and reduce the volatility. So if you have, for example, if an advisor has a management style where they like to hold a core equity holding and then add some satellite positions, whether it's international or emerging markets, and they want to add that as a complement to a core type holding, I think the fundamental models would work in a better in that case. Whereas if they primarily are creating their own core holding and they want to go ahead and add some technical type of model, I think that's where the tactical model falls in.
Great. Perfect. That makes sense. Any other questions? Just wanted to open it up. No? Okay, perfect. Well, great. I think with that, we're all set. And so, Dan, I want to thank you again very much for your time today. This is great. And if anyone, Dan's contact information is listed here. If anyone wants more information on T2, you could definitely get in touch with the relationship manager as well. Here, we're happy to go ahead and get you more information or set up a call if need be. But Dan, thank you so much for your time today.
Thank you very much, Patrick. I really look forward to our relationship with Adhesion, and anything that I could do to help out your advisors, I'm more than happy to do so.
Fantastic. Thanks so much.